All right, let's break it down word by word, step by step, and make it super easy to understand. Imagine we are talking about something simple that happens in your home. Let's start. What is public finance? First, think about money in your home. Your parents earn money, income, and then spend it to run the house, expenditure. Similarly, a government earns money and spends it to run the country. This is called public finance. It studies how the government earns money and spends money to manage the country. How does the government earn money? 1. Just like your parents earn money from their jobs, the government earns money through taxes, money collected from people and businesses. Example, when you buy something, part of the price is tax. Borrowing, taking loans from other countries or banks. Selling resources, like selling oil or land. How does the government spend money? 2. The government spends money on building roads and bridges, infrastructure, schools and hospitals, public services, paying salaries to police, teachers and government workers, helping the poor, social welfare programs. Why does the government do this? Think about this. Your parents don't just spend money for fun, they spend it to take care of the family. The government spends money to take care of the whole country. It wants to keep prices stable so things don't get too expensive. Grow the economy so everyone gets more jobs and opportunities. Make life fairer by helping the poor and reducing inequality. What are fiscal policies? Now imagine your parents decide to save more money this month or to spend more on repairing the house. These decisions are policies. Similarly, fiscal policy is the government's plan for how much to tax, how much to spend. Examples of fiscal policies. 1. Lower taxes. If taxes are reduced, people have more money to spend. This can make the economy grow. Example, during a festival, your parents may cut back on savings to buy gifts for everyone. 2. More spending. If the government spends more on building schools, it creates jobs for construction workers and helps kids get education. 3. Higher taxes. If the government needs to reduce debt, it may increase taxes. Why is public finance important? Imagine your parents didn't plan their money well. They spend too much and have no savings, or they don't spend at all and the house falls apart. This is what happens when public finance is poorly managed. The government needs to balance earning and spending to keep the country running smoothly. Key takeaways. Public finance equals how the government manages money, earning and spending. 2. Income sources, taxes, borrowing, selling resources. 3. Expenditure, roads, schools, hospitals and helping people. 4. Fiscal policy, government's plan for taxes and spending. 5. Goal equals stability, growth and fairness for all. A super simple example. Imagine a park in your neighborhood. The government collects money from you and your neighbors, taxes. It uses that money to plant trees, build benches and maintain the park. This makes the park beautiful and everyone enjoys it. If there's a storm and the park is damaged, the government may decide to spend more to fix it. This is public finance in action. Did you get it? Let me know if you want me to part more simply. What is a government budget? Imagine a family. Every month, the family earns money, salary, rent, etc. They also spend money on groceries, rent, school fees, etc. To manage this, they make a plan of how much to earn, spend and save. A government budget is similar. The government plans how to earn money, taxes, loans. It also plans how to spend money, roads, schools, defence. This plan is written down every year in a document called the budget. Why does the government make a budget? The Constitution says so. According to Article 112 of the Indian Constitution, the government must prepare a money plan every year. This is called the annual financial statement. To manage money wisely, the government knows how much it will earn. It decides where to spend and how much to save. To track income and expenses, without a budget, it is hard to know if money is being wasted or used properly. When does the budget start and end? The budget is for 1 year. It starts on April 1st and ends on March 31st of the next year. This is called the financial year. How is the budget divided? The government splits its budget into two parts. One, revenue budget. This is for the daily needs of the country. It includes money earned and spent on regular activities. Think of it like your family's monthly expenses. Income, salary or rent. Spending, groceries, electricity bills, school fees. Government examples, income, taxes collected from people and businesses. Spending, salaries for teachers, doctors and police. Maintenance of schools, hospitals and roads. 2. Capital budget. This is for big investments and future growth. It includes money for projects and assets. Think of it like saving for a big goal, saving to buy a house, a car, or start a business. Government examples, income, borrowing from banks or other countries, selling government-owned land or assets, spending, building new roads, railways and airports, buying military equipment. Why have two parts to the budget? Separate daily needs from big goals. Daily needs, revenue budget, are for now. Big goals, capital budget, are for the future. Simple example, daily needs, paying your electricity bill every month. Big goal, saving money to build a house. Where does the government get money from? Taxes, income tax, GST and other taxes people and businesses pay. Example, when you buy a chocolate, GST is included in the price. Loans, if taxes are not enough, the government borrows money. This is like taking a loan from a bank when your salary isn't enough. Other income, selling government-owned land or companies, earning money from railways or government factories. How does the government spend money? On people's needs. Schools, hospitals, roads, trains and water supply. On defence and security, army, police and border security. On paying back loans. If the government borrowed money earlier, it has to repay it. How does the budget affect you? Taxes. If the government needs more money, it might increase taxes. If it has enough, it might reduce taxes. Better services. More money in the budget means better roads, schools and hospitals. Jobs. When the government invests in projects like building bridges, it creates jobs. A simple example of budget planning. Imagine your family earns $50,000 a month. Revenue budget daily needs. $30,000 is spent on rent, groceries, school fees and electricity. This is like the government spending on salaries and maintenance. Capital budget, big goals. $10,000 is saved to buy a house. This is like the government building a new road or dam. Borrowing. If there is an emergency, e.g. the car breaks down, the family may borrow $10,000 from a bank. Similarly, the government borrows money for urgent needs. Key points to remember. A budget is a yearly plan for income, receipts and expenditures. Revenue budget handles daily running costs. Capital budget handles big investments for the future. The government gets money from taxes, loans and other sources. It spends money on services, defence and projects. Let me know if you need further simplification or more examples. What is a railway budget? A railway budget was a separate plan just for railways. It showed how much money the government would spend on railways. It also showed how much money the railways would earn. Why was railway budget separate? Imagine a big family. The family earns and spends money together, but one person runs a shop. They keep a separate account for the shop to manage its earnings and expenses. Similarly, railways in India are a big system, like a shop in a family. Managing railways is different from managing schools, roads or hospitals. So, in 1921, the railway budget was separated from the general budget. Who suggested this? The Ackworth Committee suggested separating the railway budget in 1921. They said it would make managing railways easier. When did it change? From the 2017-18 financial year, the railway budget and general budget were combined again. Now, there is one budget for everything, including railways. Why combine again? Keeping two budgets was complicated. Combining them saves time and effort. It helps plan better because the railway is part of the overall government plan. What is the general budget? The general budget is the government's plan for how to earn and spend money. It is like a household budget where you plan earning, salary, rent, or business income, spending, groceries, electricity, school fees. Stan. 3 sets of figures in the general budget. When the government prepares the budget, it includes 3 types of numbers. 1. Actual figures. What was actually earned and spent in the previous year. Example, for the 2019-20 budget, the previous year is 2018-19. 2. Budget estimates. A plan for earning and spending in the current year. Example, for the 2019-20 budget, this means plans for 2019-20. 3. Revised estimates, updated numbers for the current year based on actual performance. Example, if plans for 2019-20 were to earn 10 lakh but only 8 lakh was earned by December, this is revised. 4. Next year's estimate, a forecast for the next year's earnings and spending. Example, for the 2019-20 budget, the next year is 2020-21. Simple example to understand. Imagine your family. Last year, 2018-19, you earned 5 lakh, you spent 4 lakh. This year's plan, 2019-20, you plan to earn 6 lakh and spend 4.5 lakh. This year's revised numbers, 2019-20, by December you earned 4.5 lakh, so you adjust your plan. Next year's plan, 2020-21, you estimate earning 6.5 lakh and spending 5 lakh. Why have 3 sets of numbers? It helps track what has happened, what is happening, and what might happen. This way, the government can adjust its plans to manage money better. Why is this important? The budget helps the government plan for big projects like schools, hospitals, and railways. It ensures money is not wasted. It shows how taxes are being used for the country's growth. Let me know if you need further examples or more clarification. What is the annual financial statement? The annual financial statement is like a detailed money diary of the government. It shows how much the government plans to earn and spend in a year. It is the main document of the government's budget. The Constitution of India makes it mandatory under Article 112 for the government to present this statement every year. How is the annual financial statement divided? The money the government spends is split into 2 parts. 1. Revenue account. This is for day-to-day expenses. It includes earnings, income, and expenses spending that happen regularly. 2. Other accounts. Capital account. This is for long-term investments. It deals with spending on big projects like building roads, airports, and railways. What is the union budget? The union budget is the complete money plan for the country. It includes both the revenue account and the capital account. Why separate revenue and capital accounts? Imagine a family. Daily expenses like groceries, electricity, and school fees are managed separately. Big investments like buying a house or starting a business are planned separately. Similarly, for the government, revenue account, daily needs like paying salaries and running schools. Capital account, big projects like building a bridge or buying trains. Let's break it down further. 1. Revenue account, revenue budget. This is for regular income and spending. Income examples, taxes from people and businesses like GST, income tax, fees or fines collected by the government. Spending examples, paying salaries to teachers, doctors and police, running hospitals, schools and government offices. Example, imagine your family earns 50,000 a month. You spend 40,000 on rent, groceries and school fees. This is like the revenue account, monthly income and expenses.
Step 2.
Capital account, capital budget. This is for long-term projects and investments. Income examples, loans from banks or other countries, selling government land or companies. Spending examples, building highways, dams or airports, buying military equipment or new trains. Example, your family saves 10,000 a month to buy a car next year, or you take a loan to build a new house. This is like the capital account, planning for the future. Why is this important? 1. Clear planning. Separating accounts helps the government plan better. Daily expenses are managed separately from big projects. 2. Accountability. People can see how the government is spending money. It ensures no money is wasted. 3. Growth and development. The revenue account ensures daily operations run smoothly. The capital account focuses on creating new opportunities and infrastructure. A simple example to remember: imagine your life budget. Revenue account, daily expenses, earning 50,000 per month, like taxes, spending 40,000 on rent, groceries and school fees. 2. Capital account, big projects, saving 10,000 per month to buy a car, borrowing 5,000 to build a house. Now combine them. Your complete budget includes both daily expenses and big plans. This is like the union budget, which includes both the revenue and capital accounts. Key takeaways. Annual financial statement is the government's yearly money plan. It includes revenue account, daily needs, and capital account, long-term projects. Together, these two parts form the union budget. This division ensures clear planning, accountability, and focus on growth. Let me know if you need more examples or further clarification. What are the government's accounts and funds? The government keeps its money and records in 3 main accounts. Think of these accounts like jars where the government stores and uses its money. Let's talk about one of these jars. The Consolidated Fund of India. 1. What is the Consolidated Fund of India? Imagine you have a piggy bank where you keep all your earnings and loans. You also use this same piggy bank to pay for all your expenses. This piggy bank for the Government of India is called the Consolidated Fund of India. It is created under Article 2666(1) of the Constitution. 2. What goes into this fund? The government puts all the money it earns or borrows into this fund. Here's what goes inside. 1. All revenues, taxes collected from people and businesses, like GST income tax. Non-tax revenues, like fees, fines, or money earned from government services, like railways. Example: if you earn 50,000 a month, that's your revenue. Similarly, the government earns through taxes and fees. 2. Loans raised by the government. When the government needs extra money, it borrows, takes loans from banks, other countries, or people. Example: if you take a loan of 100,000 from the bank, this is like the government borrowing money. 3. Recoveries of loans granted by the government. If the government lends money to someone, like a state government, and they repay it, this repayment goes into the Consolidated Fund. Example: imagine you loaned 10,000 to a friend and they return it to you. That returned money goes back into your piggy bank. Amala 3. How is the money used? All government spending comes from the Consolidated of India. Salaries for government employees, teachers, doctors, police, building schools, roads and railways, defence and security expenses. Important rule: the government cannot just take money from this fund whenever it wants. It needs permission from the Parliament. This is like asking for approval before spending. Number 4. Why is this fund important? Centralised money management. All earnings and borrowings are in one place, making it easy to track income and expenses. Parliamentary oversight. The Parliament ensures money is spent wisely and not wasted. A simple example to understand. Imagine your family budget. All your salary, loans and returned money from friends are kept in one account. You use this account to pay rent, buy groceries or save for future needs. But you can't spend without first discussing it with your family, like the government asking the Parliament for permission. Summary of the Consolidated Fund of India. 1. What is it? A giant piggy bank for the government. 2. What goes in? Taxes, loans and repayments of loans. 3. What comes out? Money for running the country, schools, roads, salaries, defence. 4. Who controls it? The Parliament must give permission for spending. If you want to know about the other 2 accounts of government, let me know. Public Account of India. The Public Account of India is another special account of the government mentioned in Article 266(2) of the Constitution. Let's understand it in the simplest way possible. 1. What is the Public Account of India? Think of it as a safe deposit lock held by the government. The government keeps money for others in this account. This money does not belong to the government. The government is only holding this money temporarily until it gives it back to the rightful owners. 2. What money goes into the public account? Here are examples of the money held in trust by the government. Provident funds. Government employees save a part of their salary in a provident fund for their future. This money is kept in the public account until the employees withdraw it. Example. Imagine you save 1,000 every month in a piggy bank at your friend's house. Your friend is keeping the money safe for you, but it still belongs to you. 2. Small savings schemes. People invest their money in schemes like post office savings, national savings certificates, or Sukanya Samriddhi Yojana. This money is kept in the public account until it is returned with interest. Example. If you give 10,000 to a bank to keep it safe, the bank will hold it in trust and return it to you later with interest. 3. Other deposits. Court deposits, government security deposits, and other temporary deposits are also kept here. These funds belong to individuals or organisations, not the government. 3. Can the government spend this money? No, the government cannot use this money for its own expenses because it belongs to people or organisations, not the government. The government is only acting as a custodian caretaker of this money. 4. How is the public account different from the consolidated fund? Consolidated fund, public account. The government is only acting as a own money, taxes, loans. Money held in trust, savings, deposits. Needs Parliament's permission to withdraw. Does not need Parliament's permission, used for running the country, returned to rightful owners later. Or 5. Why doesn't the public account need Parliament's approval? Since this money doesn't belong to the government, it doesn't need Parliament's permission to withdraw it. The government simply pays it back when people ask for it. 6. Why is the public account important? 1. Trust. People trust the government to safeguard their money. 2. Accountability. The government ensures this money is returned safely to its owners. 3. No confusion. Keeping this money in a separate account ensures it is not mixed with the government's funds. Simple example to understand. Imagine you're a bank. 1. People deposit their savings, like 1,000 or 10,000. 2. You hold this money in a special account, not for your own use, but to return it later when they ask for it. 3. You don't need anyone's permission to give them their own money back. The government does the same with the public account. Summary of the Public Account of India 1. What is it? A special account where the government holds money in trust for others. 2. What goes in? Provident funds, small savings and other deposits. 3. What comes out? The same money is returned to the rightful owners when they ask for it. 4. Who controls it? The government acts as a custodian and does not use this money for its own expenses. Let me know if you'd like further clarifications or examples. Public Account of India. The Public Account of India is another special account of the government mentioned in Article 266(2) of the Constitution. Let's understand it in the simplest way possible. 1. What is the Public Account of India? Think of it as a safe deposit lock held by the government. The government keeps money for others in this account. This money does not belong to the government. The government is only holding this money temporarily until it gives it back to the rightful owners. 2. What money goes into the public account? Here are examples of the money held in trust by the government. Provident funds. Government employees save a part of their salary in a provident fund for their future. This money is kept in the public account until the employees withdraw it. Example. Imagine you save 1,000 every month in a piggy bank at your friend's house. Your friend is keeping the money safe for you, but it still belongs to you. 2. Small savings schemes. People invest their money in schemes like post office savings, national savings certificates, or Sukanya Samriddhi Yojana. This money is kept in the public account until it is returned with interest. Example, if you give 10,000 to a bank to keep it safe, the bank will hold it in trust and return it to you later with interest. 3. Other deposits. Court deposits, government security deposits, and other temporary deposits are also kept here. These funds belong to individuals or organizations, not the government. 3. Can the government spend this money? No, the government cannot use this money for its own expenses because it belongs to people or organizations, not the government. The government is only acting as a custodian caretaker of this money. 4. How is the public account different from the consolidated fund? Consolidated fund, public account. The government is only acting as a own money, taxes, loans. Money held in trust, savings, deposits. Needs Parliament's permission to withdraw. Does not need Parliament's permission, used for running the country, returned to rightful owners later. Or 5. Why doesn't the public account need Parliament's approval? Since this money doesn't belong to the government, it doesn't need Parliament's permission to withdraw it. The government simply pays it back when people ask for it. 6. Why is the public account important? 1. Trust. People trust the government to safeguard their money. 2. Accountability. The government ensures this money is returned safely to its owners. 3. No confusion. Keeping this money in a separate account ensures it is not mixed with the government's funds. Simple example to understand. Imagine you're a bank. 1. People deposit their savings, like 1,000 or 10,000. 2. You hold this money in a special account, not for your own use, but to return it later when they ask for it. 3. You don't need anyone's permission to give them their own money back. The government does the same with the public account. Summary of the public account of India. 1. What is it? A special account where the government holds money in trust for others. 2. What goes in? Provident funds, small savings and other deposits. 3. What comes out? The same money is returned to the rightful owners when they ask for it. 4. Who controls it? The government acts as a custodian and does not use this money for its own expenses. Let me know if you'd like further clarifications or examples. Alright, let's break it down even more, step by step, in the simplest way possible. What are receipts? The government, like any household or company, needs money to function. The money the government earns is called receipts. Just like a family might earn money from a job, rent or savings interest, the government earns money from different sources. These receipts are divided into 2 main parts. 1. Revenue receipts. Revenue receipts are like the government's monthly income, money it earns regularly. Key points about revenue receipts. This money comes without borrowing or selling anything. It doesn't create any debt for the government. It doesn't reduce the government's assets like property, land or businesses. 2 types of revenue receipts. 1. Tax revenue. 2. Non-tax revenue. A. Tax revenue. This is the biggest way the government earns money. A tax is money the government collects from people and businesses. Everyone has to pay taxes, and this money is used for public services like building roads, schools, hospitals, etc. Types of taxes in tax revenue. 1. Direct taxes. These are paid directly to the government by people or companies. Example, income tax. People pay this based on their earnings. Corporate tax. Companies pay this based on their profits. 2. Indirect taxes. These taxes are included in the price of things we buy. Sellers collect the tax from buyers and pass it on to the government. Example, goods and services tax, GST. When you buy a phone or groceries, a small part of the price is tax. Custom duty, tax on goods imported from other countries like foreign cars or gadgets. B. Non-tax revenue. This is the money the government earns without collecting taxes. Examples of non-tax revenue. 1. Interest receipts. The government lends money to state governments or government organizations. When they repay the loan, they also pay interest, extra money, which becomes income for the government. 2. Dividends and profits. The government owns shares in some companies. Dividends are the profit shares these companies give to the government. It also runs fully government-owned businesses like railways and ONGC, a big oil company. The profits from these are also income for the government. 3. Grants in aid. Sometimes other countries or organizations like the United Nations give money to help India develop or during disasters. Simple example to understand revenue receipts. Imagine you're running a small shop. Tax revenue. You set up a donation box in the shop and ask customers to pay extra tax for cleaning and security services. Non-tax revenue. You also lend money to your friend. When your friend pays back the loan with some interest, that's your non-tax income. Why revenue receipts are important. For daily operations, the government needs this money to pay salaries, maintain public services like police, schools, hospitals, and build infrastructure like roads. Debt-free income. This money is earned, not borrowed, so it doesn't add to the government's debt. Summary table, revenue receipts, type purpose, dividends, grants. Tax revenue, income tax, GST, customs duties. Money collected by taxing people and businesses. Non-tax revenue, interest, dividends, grants. Money from loans, investments and aid. Let's compare it to a family budget. Tax revenue. Imagine your dad gets a salary every month. That's like the government collecting taxes from people. Non-tax revenue. Imagine your mom invests in shares and earns money dividends or gets interest from savings in a bank. That's like the government earning non-tax revenue. Revenue receipts help the government run smoothly without borrowing money or selling assets. If you want more examples or need this even simpler, let me know. Let's dive deeper and explain fiscal services, general services, and fees, fines, and penalties in a step-by-step, very simple way. I'll add more examples and details to make it super easy to understand. What are we talking about? Governments need money to run the country. Taxes are one way they earn money, but they also earn from other sources. These other sources include 1. Fiscal services, 2. General services, 3. Fees, fines. 1. Fiscal services, government as a producer. The government makes and provides important items like money, coins, and stamps. It earns money from this process. Main ways the government earns through fiscal services. 1. Currency printing. The government prints paper money, currency notes, for use in the economy. Banks and other institutions pay for these services. 2. Coin minting. The government makes coins in special factories called mints. This process earns the government income. 3. Stamp printing. Stamps are used on legal documents, postage, or court-related papers. Selling these stamps also generates money for the government. Example for fiscal services. Imagine you bake cakes at home. If you sell these cakes to others, you earn extra money. Similarly, the government prints and mints products like currency and stamps and earns by providing them. 2. General services, government as a service provider. The government provides many useful services to people and businesses. Some of these services generate income. Key types of general services. 1. Banking services. The government earns from running banks or regulating the banking sector. Example, a government bank like SBI gives loans and earns interest from borrowers. 2. Insurance. The government owns insurance companies like LIC in India. These companies earn profits, which go to the government. 3. Irrigation services. The government builds dams and canals to provide water for farming. Farmers pay for using this water. 4. Power distribution. Electricity provided to homes and businesses earns money for the government. 5. Receipts from central police services. When the government provides special police forces for private security, it charges fees. 6. Public service commissions. Organizations like the UPSC conduct exams. Candidates pay exam fees, which is an income for the government. Example for general services. Imagine your family has extra land. You charge a farmer to grow crops on that land, irrigation income. You install solar panels and sell electricity to neighbours, power distribution, income. You also charge people to use your well for water. Just like this, the government earns from the services it provides. And 3, fees, fines and penalties. Government as a rule enforcer. The government earns money when people use its services or break rules. 1. Fees. People pay for specific services. Example, exam fees like UPSC, SSC, driving license fees, land registration fees. 2. Fines. If someone breaks a law, they have to pay a fine. Example, not wearing a helmet or speeding results in a traffic fine. 3. Penalties. Penalties are charged for delays or violations. Example, late payment of taxes or bills results in a penalty. Example for fees, fines and penalties. Think about a school. You pay exam fees to appear for tests. If you break a rule, like damaging property, you pay a fine. If you return library books late, you pay a penalty. The government works the same way. It earns from fees, fines and penalties. Why are these incomes important? 1. They provide extra money to the government. 2. This money can be used to build roads, schools and hospitals, pay salaries to government workers, fund welfare programs for the poor. They reduce the need for the government to increase taxes. Final simplification recap. Category, what it means. Examples. Minting coins, selling shares. Fiscal services. The government earns money making products like currency, coins and stamps. Printing notes, minting coins, selling stamps. General services. The government provides services and earns from them. Banking, insurance, electricity, irrigation. Fees, fines, penalties. The government charges for services or rules violations. Exam fees, traffic fines, late tax penalties. Think of the government like a big family. It makes products like stamps and coins to sell. It offers services like water and electricity for a price. It charges fees and fines when you use special services or break rules. This helps the government earn extra money to take care of the country. Let me know if you'd like even more examples. Let's break down capital receipts into the simplest, most understandable terms. I'll explain every detail step by step with easy examples so even a complete beginner can understand. What are capital receipts? Well, 1. Capital receipts are a way for the government to bring in money. 2. They come from 2 main actions. Creating liabilities. This means borrowing money, taking a loan. Selling assets. This means selling something the government owns. 2 important things to remember about capital receipts. 1. They create liabilities. A liability means the government has to pay back the money later. Example, borrowing money from other countries or banks. 2. They reduce assets. An asset is something valuable the government owns. When the government sells it, the value of its assets goes down. Sources of capital receipts. There are 3 main ways the government earns money as capital receipts. Borrowing, creating liabilities. The government borrows money from various sources, which it promises to return with interest. Borrowing creates a liability because the government has to pay this money back. Types of borrowing. 1. External borrowing. Borrowing money from other countries or international organizations like the World Bank or IMF. Example, India takes a loan from Japan to build a high-speed train. 2. Internal borrowing. Borrowing money within the country, usually from banks or by issuing bonds. Example, the Reserve Bank of India gives a loan to the government. 2. Recovery of loans. The government gives loans to state governments, public companies, or individuals. When these loans are repaid, the money comes back to the government as capital receipts. Example, suppose the central government gives 100 crore to a state government for building roads. When the state government repays this loan, the central government receives the money as a capital receipt. Sale of assets, disinvestment. The government sells assets like land, buildings, or shares in government-owned companies. This reduces the government's assets but brings in money. Example, the government owns a company like Air India. If it sells part of its shares to private companies or individuals, the money earned is a capital receipt. Similarly, selling government land or property also counts as capital receipts. Key difference between capital and revenue receipts. To make it easy, capital receipts, revenue receipts, reduce assets. Example, create a liability, e.g. loans, or reduce, do not create liability or reduce assets. Example, borrowing money or selling assets. Example, taxes or income from government services. Why are capital receipts important? 1. They help the government manage big expenses, like building highways, railways, or hospitals. 2. Borrowing allows the government to spend now and repay later. 3. Selling assets, disinvestment, can reduce the financial burden of managing those assets. Everyday example of capital receipts. Imagine you are running a small shop. 1. Borrowing money. You take a loan from a bank to buy more stock for your shop. This creates a liability because you must pay the loan with interest. 2. Selling assets, reducing assets. You sell your old delivery van and use the money to buy new goods for your shop. This reduces your assets. You no longer have the van. 3. Getting back loans. Suppose you had lent money to a friend. When they repay you, this is like the government recovering loans. Real life example for India. 1. External borrowing. India borrowed money from the World Bank to support COVID-19 relief efforts. 2. Recovery of loans. The Indian government gave loans to some state governments. When those states repaid the loans, it became capital receipts. 3. Disinvestment, selling assets. The government sold a portion of its shares in Life Insurance Corporation, LIC, during an IPO. The money earned was a capital receipt. Final simplification recap. What it means. Loans from World of Loans. Borrowing. The government borrows money which it must repay later. Loans from World Bank. Bonds sold to people. Recovery of loans. Money comes back when someone repays a loan given by the government. State governments repaying their loans. Sale of assets, disinvestment. The government sells things it owns, like land or shares, to earn money. Selling Air India shares or government property. Think of the government like a person managing a budget. If they borrow money, they have to pay it back. If they sell something they own, they get money now but lose that asset forever. If they recover money from loans they gave earlier, it boosts their cash flow. Let me know if you need more examples or details. Let's break down revenue expenditure step by step in the simplest way possible using examples to make it super clear. What is revenue expenditure? 1. Revenue expenditure is the money the government spends on its daily activities. 2. This kind of spending doesn't help the government earn money in the future. 3. It's like one-time spending. Once the money is spent, the government cannot get it back. 4. This is necessary for the government to keep running, but the money spent on it doesn't come back as profit. Main features of revenue expenditure. Ongoing expenses. The money spent on things that are needed for the day-to-day functioning of the government. No future return. The money spent cannot be recovered or turned into profit. One-time payment. The government spends the money and it's gone, like paying for salaries or buying equipment. What does revenue expenditure include? 1. Interest payments. The government borrows money, and when it does, it has to pay interest on the money it borrowed. Interest payments refer to the money paid to those who lent money to the government, either from internal sources within India or external sources from other countries or international banks. Example, if the government borrowed 1,000 crore, it will pay a certain amount as interest every year. That interest payment is revenue expenditure. 2. Defence and police. The government spends money on defence like buying weapons, maintaining military forces, and police, law enforcement, public safety. But not everything in defence is a revenue expenditure. Some spending on defence equipment might be a capital expenditure if the equipment will be used for many years. Example, paying the salaries of soldiers, buying ammunition and maintaining police stations are part of revenue expenditure. Through subsidies. The government gives money to certain sectors or groups of people to help them. This is called a subsidy. For example, the government may provide subsidies on food items like rice or wheat for poor people, or subsidies for farmers to encourage them to grow crops. Example, the government gives 5 rice to people living under the poverty line instead of charging them 40. This 35 difference is a subsidy. 4. Salaries and pensions. The government needs to pay salaries to its employees, such as teachers, doctors, clerks, and other public servants. It also has to pay pensions to retired employees. Example, the salary paid to a school teacher or the pension given to a retired soldier is a revenue expenditure. 5. Other expenditures. The government has other regular expenses which are needed to run the country. These include grants to states and union territories. The central government gives money to states and union territories for their development or to help them in difficult situations. Example, the government may give 500 crore to a state for building roads or schools. Social services. This includes money spent on things like education, healthcare, poverty alleviation, and social security. Example, government funding for hospitals or schools, or the pension scheme for senior citizens. Economic services. This includes money spent on helping different industries like agriculture, power, transportation, and communication. Example, money spent on building irrigation systems for farmers or on improving roads and railways. General services. These are everyday services that keep the government running smoothly, like tax collection, managing foreign relations, or managing the country's economy. Example, paying for diplomats and embassies or the costs involved in tax collection. Key points to remember about revenue expenditure. Doesn't create future benefits. The money spent doesn't come back as profit. Day-to-day expenses. These are the regular, ongoing costs the government needs to keep the country functioning. Government's regular bills. Think of this like the bills you pay for everyday needs, rent, electricity, groceries, but on a much larger scale, like paying salaries or maintaining defense systems. Comparison, revenue versus capital expenditure. Revenue expenditure, capital expenditure. Spent on regular, ongoing costs like salaries, defence, subsidies, spent on long-term investments like buying land, equipment, no future return from the money spent, creates future assets or value for the government. Example, paying a teacher's salary. Example, buying machinery for a power plant. Everyday example of revenue expenditure. Imagine you run a small shop. Revenue expenditure, you pay 500s to your workers every month, their salaries. You pay 100s to the electricity company for the monthly bill. You spend 50s on packaging for your products. Capital expenditure. You buy a new refrigerator for 10,000 to store more goods. You spend 5,000 to renovate the shop, which will help you in the long run. In both cases, you need money to run the shop. However, your revenue expenditure is something you pay regularly and you don't get it back, while capital expenditure is a larger investment with lasting value. Real-life example for India. 1. Interest payments. India has borrowed money from the World Bank for development projects. Every year, India pays interest on these loans. 2. Defence and police. India spends money on defence forces, police salaries and defence equipment. 3. Subsidies. The Indian government provides food subsidies through schemes like Public Distribution System PDS, which gives food grains at low prices. 4. Salaries and pensions. Salaries of government employees like teachers, doctors and soldiers are part of revenue expenditure. 5. Social services. Government spends money on healthcare services like government hospitals and on education like building schools. Recap of revenue expenditure, what it is, example, and it's bills, day-to-day government spending, paying salaries, subsidies, maintaining law and order, doesn't create assets or returns once spent, regular expenses like bills, government paying for services and programs. I hope this explanation makes revenue expenditure super clear for you. Feel free to ask if you need more examples or have any questions. Let's break down capital expenditure in the simplest way possible. Imagine you're spending money on things that will help you earn or save money in the future, or things that will last a long time. What is capital expenditure? Capital expenditure is money spent by the government on things that create permanent assets or things that will help make money in the future. It's not like paying for regular things that you use up right away, like electricity or food. Instead, it's money spent to build things that will last for a long time, like roads, schools, or defense equipment. In short, capital expenditure is spent on things that create value and that the government can use or sell later to get money back. Key points of capital expenditure. 1. Creates permanent assets. The government spends money on things that last for a long time. These assets can help earn money or make life easier in the future. Example, if the government builds a bridge, it's a permanent asset because it will last for many years. It can help people travel and do business, making the country stronger. 2, can generate regular income. Sometimes the government spends money on things that will earn money regularly, like building a business or investing in industries. Example, the government builds a power plant that sells electricity. The government gets money regularly from people who buy electricity. 3, loans. The government can also lend money to others, like states, local bodies, or businesses, which can be paid back with interest. This is like investing in others but expecting returns, money back later. 4, two-way payment. It means that the government spends money now but can get money back in the future, either through income like from a business or asset, or by selling the asset. Example, if the government builds a railway station, it may spend a lot of money now, but later it can sell tickets to travellers, getting money back. Different types of capital expenditure. 1. Loans given by the government. This is when the government lends money to other people or organisations. This can be internal loans, money given to states, public companies, PSUs, or banks within the country. External loans, money given to other countries or foreign organisations. Example, the government might give a loan to a state government to help it build roads or pay for health programmes. 2. Loan repayments of past borrowings. Sometimes the government has borrowed money in the past. Now it needs to pay back the original amount, the capital it borrowed. This is called loan repayment. The interest, extra money on the loan, is shown as revenue expenditure because it is a regular payment, but the money that pays off the borrowed amount is part of capital expenditure. Example, if the government borrowed 1,000 crore from a bank in the past, now it has to pay back 1,000 crore. This repayment is a capital expenditure. 3. Capital defence expenditure. The government spends money on things that help defend the country. This includes buying weapons, ships, airplanes, and defence equipment. It's also about modernising the army and the police. Example, if the government buys a new fighter jet for the Air Force, that is capital expenditure because the jet will last for many years and help keep the country safe. 4. General services, building and maintaining infrastructure. This is money spent on things that will last for a long time and help the people of the country. It includes things like railways, building and maintaining railways. Post office, setting up and maintaining post offices. Water supply, building water supply systems to ensure people have clean water. Education and health, building schools, hospitals, etc. Example, if the government builds a new school in a village, this is a capital expenditure because the school will last for a long time and will help educate children in the future.
5.
Other liabilities. This category includes things the government has to pay back in the future for capital receipts, money the government borrowed or received from selling its assets. For example, if the government sold some of its land to a private company, the money it receives is called capital receipts, but it might also have future payments or responsibilities related to that deal, which are included in this category. Example, if the government sells land to build a shopping mall, it might get money now, but it may have future costs like paying for maintaining public areas or services. Summary of capital expenditure. Capital expenditure is spent on things that create long-lasting assets for the country or bring in future income. It is like building something that will last a long time and give returns money later. It includes loans to others, defense equipment, infrastructure, and building public services. Real life example. Imagine you want to start a small food delivery business. You decide to 1. Buy a delivery van, capital expenditure. This van will help you earn money for years. 2. Take a loan from a bank to help buy the van, loans given by the government. 3. Repay the loan later, loan repayments. 4. Build a small office, creating permanent assets where you can manage the business. This is like the government spending money on building roads, bridges, and buying equipment that will last a long time and bring in money in the future. Key differences between revenue expenditure and capital expenditure. Revenue expenditure is for daily needs, like paying salaries, interest, subsidies. Once spent, it's gone. Capital expenditure is for things that create long-lasting value, like buildings, equipment, and loans, and may bring back money later. I hope this explanation makes capital expenditure crystal clear. If you need more examples or any further explanation, feel free to ask.